for the next decade. That's one take at least. That stock is down by 7.5%. Let's talk crude. The bullish energy crowd is starting to grow louder. Goldman's Jeff Currie expecting a spike in crude prices over the next 12 to 18 months.
Manufacturing data coming out of China is some of those green shoots we need to see to get the bull story ramped back up again.
The Chevron CEO, Mike Wirth, speaking to Alex Steele, getting behind that bullish view.
All the leading indicators would suggest that economic activity is picking up, energy demand is picking up, and I think as we get into the middle of this year and certainly into the second half of this year, that demand is likely to tighten markets a little bit.
Happy to catch up with Sarah Hunt of Alpine. Now, Sarah, wonderful to catch up with you once again. I know you like the opportunities in this sector. Run us all through it.
So I think that there are two different parts to this story, right? One of them is the oil story, which I agree with. If you are starting to see China really start to move, that's something that people have been looking for. You have a decade's worth probably of underinvestment because of the thesis that we were going to get away from hydrocarbons. So on the oil side, that's a transportation story. So all this, the fact that the airlines are doing very well, part of what's helping them has been lower oil prices. But if you start to see oil prices come up, that's going to impact their earnings. If you look at the natural gas side of things, which we look at very much for Europe, I think there's a story in LNG, and I think you've got a couple of different pieces to that. One of them is the actual producers of LNG, which is companies like Cheniere. And other companies are the ones that play into that infrastructure, which is something like Chart Industries that recently made an acquisition that's going to be very good from an industrial standpoint, but people weren't happy about the financing. So you now have a chance to look at that stock at a lower level than you did for the last year or so.
Sarah, in relative terms, there was a spread that opened up between some of the energy players in Europe and the energy players in the United States. Perhaps the windfall tax was part of that. Can you run us through why you think that was and why maybe that closes this year?
Well, I think there's an investment part of it and there's a tax part of it, right? So there's whether or not companies are making those investments and whether or not they can get product to actually get it to market. And I think the concern over the windfall tax was very real. And if you look at years of companies who have had problems when you had low commodity prices, not getting any subsidies, but now being asked to pay more and being basically castigated for buying their stock back instead of investing more, when a year ago or 2 years ago they were being told that oil was going away and you shouldn't be investing. I think it's a very tough place for those, very tough for those companies to navigate the political and geopolitical issues that are going on with oil. But I think that the fact that we're not talking about having that tax does help. And I also think that in Europe you've got higher taxes anyway, so it's a combination of things in the spread between those two areas.
It's tough to navigate this equity market right now. The S&P's down 6/10, the Nasdaq's down about 1 full percentage point. You've seen this big move in the front end. The 2 years now 493, pushing 5%. I know you watched this interview yesterday, Sarah, so I just took a snapshot of it for us both to listen to. This was David Page of AXA. Take a listen.
The moves that you would get if you followed a Bullard type approach is much more consistent perhaps with Fed history, that you could see the rates move a little bit higher to peak, maybe even towards a peak of 6%. But then once you reach that, you would break the economy. You would have to see rate cuts follow quite quickly.
Now, Sarah, everyone's going to be right eventually, but they set it at 3, nothing broke, 4, 5, and now we're talking 6.
So here's something that I find interesting about that. If you think about whether or not we were all underpricing what the Fed was going to do, which arguably if 3 was the limit, we were underpricing that 6 months ago. I wonder now if 6% is starting to overprice a little bit, although, maybe we could get up to touch there for a period of time. I think really the biggest thing that stood out to me from what he was talking about yesterday was you're using backward-looking data for forward-looking action, which is raising rates. And I think that's the most difficult thing. I mean, I know that you guys earlier this morning were talking about the whole long and variable lag issue and whether or not that has any meaning and whether or not that's an older statistic. But I do think that there are parts of the economy for which those changes don't happen so quickly. And very often, like a lot of contracts are priced yearly. A lot of things happen on a not quarter-to-quarter basis. And Wall Street is so used to focusing on the quarters that we lose sight of the fact that, wage negotiations don't happen every time the Fed changes rates. It happens once a year or once every couple of years, depending on the industry. So I think that there is an argument to be made that some of the effects are not being seen yet. But I also think you're starting to see some issues in the lower credit markets. You're seeing subprime auto, you're seeing some of the subprime credit card start to see more charge-offs. And I think that's a sign that things are getting tougher, especially on that lower end.
We got this headline in the last hour as well, that Blackstone has defaulted on a 531 million euro bond backed by portfolios of offices and stores. Are we going to see more of that, do you think, Sarah?
I don't see how you repurpose some of that. It's such a big argument right now, and I don't see how you can repurpose some of those buildings, but I think you absolutely are, because the idea in the original going back to work out of the pandemic was that people were going to go back to a regular schedule. I think 3 years has really changed that, and I think that no matter what you see about companies asking people to go back and some people going back 3 days or 4 days, you're not going to have the same occupancy that you had in a lot of those major metropolitan areas in the less than A-class buildings. I don't think the A-class buildings have a problem. I think everything below that is going to have a problem, and it's going to take some real creativity to figure out how to repurpose some of that space. And I know New York specifically is having an ongoing discussion about that, because we have so much a lack of housing, but we now have so much empty office space. But I think that that is really going to continue to be a challenge on the commercial real estate front.
Sarah, this was great. It always is. Sarah Hunt there of Alpine Saxon Woods. Here's the broader market for you. About 12 minutes into the session, equities lower by 0.5% on the S&P. On the Nasdaq, we're down by 0.75%. This equity market has to confront what's developing in this bond market, and once again, its yields up a lift right the way through the curve. 2s out to 30s, every single point across the curve with a 4 handle this morning. On a 30-year north of 4%, on a 10-year north of 4%, on a 2-year approaching 5 at 493. Up next, the push for private credit.
Your regular way direct lending deal, 12 months ago, was made in probably a little bit more of a frothy market these days. Today it's as lender friendly as it gets.
We'll get the latest from Oaktree up next.
Your regular way direct lending deal, 12 months ago, was made in probably a little bit more of a frothy market these days. Today it's as lender friendly as it gets. With where base rates are, with where spreads have moved, spreads are at least 100 basis points wider, sort of year on year. You're probably able to earn 12% on your regular way direct lending deal. For a quite good company, probably 50 LTV loan. I think that's really attractive. That's probably 400 or 500 basis points wide of where you were sort of a year and change ago.
Makes it sound easy. Double-digit returns, a grubbing void left by the big banks, fueling appetite for private credit. Some of the largest private lenders raising billions of dollars around the world to seize the opportunities. Oaktree making its move, looking to fill financing gaps in LBO lending with a $10 billion fund. I'm pleased to say that Oaktree's Armen Panossian joins us right now. Armen, wonderful to catch up with you, sir, as always. Let's start here. New entrant, why?
It's a very exciting time in the credit markets with the volatility we've seen in equity and credit, as well as the banks stepping away from the private credit markets. We believe that it's the most attractive time that we've seen in several years in private credit to originate first lien loans to private equity sponsors doing new deals at very low loan to values and very attractive returns. And Oaktree, just given the fact that we've been in private credit for actually 20 years, not so much as heavily in the large cap sponsor lending market, but we have the capabilities to really lean in heavy right now, and the benefit of not having any legacy portfolio issues that would shackle us. So we're moving in with a lot of conviction right now with a very large fundraise.
And that last point I think is really important. What are the advantages of not having those legacy policy issues, as you pointed out, legacy portfolio issues?
Unfortunately, over the last several years, there was some excessive lending practices, both in broadly syndicated or tradable loans, as well as in direct lending. That was reflected in tighter pricing than what we're seeing in the market today, a loosening of covenants, and fairly high loan to values in newly originated debt. Today, on all three of those metrics, it's more lender friendly. We're seeing spreads on newly originated loans 100 to 150 basis points wider just over the last 12 months. We're seeing base rates, SOFR, the standard overnight rate, up from roughly 1% a year ago to now over 4%. And then in terms of loan to values on new deals, routinely we would see 60 or 65% loan to values on new leverage buyout transactions a year ago. And today it's more like 40 to 50% with better legal protections as well in the form of covenants.
So you're saying... Sorry to jump in. No, please. I was just thinking, are you saying that this is getting more attractive for a lender at a time when traditional lenders are actually pulling back?
Yes, it is. The traditional lenders have legacy portfolios that are higher in loan to value, lower in price versus what is the current market. And I think there's some cracks in the economy that are showing up in portfolios that are giving them reason to pause, which is creating the opportunity for a large new entrant that is able to navigate through landmines.
Can you give us an idea of the average coupon size? And I know this is difficult because you guys have go bottom up across a range of industries, different places, but can you give me an idea of what's on offer here at the moment?
First lien private credit is being priced at about SOFR plus 6.5%, which lands at about a 12 to 12.5% coupon rate on those loans.
Looking at what's happening in traditional fixed income at the moment, with a 2-year at 4.90 and a 6-month T-bill at 5%, how competitive do you think this actually is historically?
I think it's better than what it has been historically, and I think the relevant comparison is if you look at the best 80% of the tradable credit market in below investment grade, and you compare it against newly originated private credit in today's market conditions, you're picking up about 300 to 400 basis points of spread or return in going to the private markets. So that's really the relevant comparison, and we find it to be attractive, incredibly attractive relative to the last 5 to 8 years.
And a lot of the time on this program, we spend a lot of time doing macro, top-down stuff. I know for you guys, traditionally, it's all bottom-up, it's quite micro. Within industries at the moment, are you seeing lots of dispersion, lots of opportunities away from the macro stuff?
Within industries, yes. There are certain industries that benefit from inflation. There's some opportunities there. There are other industries that there are leading positions or leading companies that are able to defend their EBITDA margins or their cash flow margins even through volatile economic and market conditions. And when there is volatility driven by market technicals, that creates an investment opportunity for fundamental investors like Oaktree.
Can we talk about landmines? Sometimes in this business, as you know, it's not what you choose to own, it's what you choose not to own. What are you avoiding?
We're avoiding sectors and businesses that have very tight cash flow margins, companies that are not able to pass through cost increases to their customers without demand destruction. Obviously, traditional retail is problematic given that backdrop. Certain types of real estate are seeing cracks as well, especially in the office space. I know your previous speaker spoke about that. But we're more focused from a bottoms-up perspective on the quality of earnings and the quality of businesses' capabilities to weather through downturns by very active cash flow management.
Do you see the risk of a situation where some of these landmines blow up and cause issues in places where they shouldn't, that people have to sell their stronger hands to cover their weaker ones? Do you see a situation like that potentially developing?
It's possible, but that type of risk was more apparent during the global financial crisis when there were vehicles that did not have matched assets to their liabilities. They had short-term liabilities with long-term assets, and it caused them to sell their best positions to really shore up their liquidity. That's not really the case right now. There really isn't mismatched assets and liabilities. So investors should be able to weather the storm and hold on to their best assets if they don't have meaningful outflows that they need to supply liquidity for.
And let's do this more often. This was a clinic, an education, as it often is. Armin Panosian there of Oaktree on their latest effort. Equities right now down a little bit. No real drama here. Down 1/3 of 1% on the S&P. On the Nasdaq, we're down about 1/2 of 1%. In the bond market, yields are higher. Talked about that through the morning. The data really pretty tremendous. Looking at jobless claims, there are no signs, at least at the headline level, of cracks in this labour market. I know beneath the surface, there's lots of pockets of weakness here and there. Tech, parts of finance, banking, etc. But yields on a 2-year, remarkable 4.93. Up next, your trading diary. .26 minutes into the session, equities down by about 1/2 of 1% on the Nasdaq, down by 1/3 of 1% on the S&P 500. In the face of this, in the bond market, yields up right across the curve. 2-year 4.90, 10-year 3.4, 10-year 3.4%, and a 30-year as well. That's the price action. Let's get you the trading diary. Coming up, more retail earnings. Costco, Nordstrom after the bell. Fed speak. Waller, Kashkari, Logan, Bostic, Bowman to round out the week. Eurozone PPI data out on Friday, plus President Biden meeting with the German Chancellor Chancellor Olaf Scholz at the White House. From New York City, that does it for me. Thanks for watching Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, March 2nd. Here are the top market stories we're following for you at this hour. Macy's Magic. So fourth quarter beats expectations, and the company sounds upbeat for the year. Stock is up 11%. We're going to get the read on the retail season. And Tesla tanks chips. So Tesla bores investors but freaks out suppliers by saying it can use less chips. We're going to get the latest after Investor Day. And crossing 4%. 10-year yields hitting the highest level since November. Job market stays strong. Labor costs jump. Equities pretty mixed. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And guys, I want to point out the S&P is below its 200-day. It's sitting right on that 100-day moving average. You got to wonder if we go below that, we're going to see some options maybe shaken out.
Yep. I'm stunned that European equities are holding up in the way that they are today, given the inflation print we had, particularly the core number. So I'm surprised actually the European equities are doing as well as they are. The dollar's fairly well bid. I take your point about what is happening technically. How much more can this equity market take stateside in terms of this higher rate story before it finally cracks? And as you say, the technical's really important. Today, Alex, I think is a day that is driven by you. Today is a day about consumer confidence. It's a day about retail. This is I know Alex thinks her wheelhouse is oil and gas, but this is where the real skill set lies.
Yeah, guys making fun of me because I love to shop. He's determined to prove that I don't love necessarily the stuff, but I like the bargain and the shopping. So he's using me to look at consumer confidence. You take a look at, say, with Macy's, right? Like their numbers weren't terrible.
Yep.
Their outlook isn't terrible, but expectations for consumer confidence is kind of terrible. So how do you kind of square that? Like I have stopped spending in the U.S.
No, you haven't.
In the U.S. In the U.S.
No, you haven't. No, you have not. Yeah, there's a definite divide between you, Mitch, and the Conference Board data, which I think was worth paying attention to. There's a real divide in the data that we're getting from the retail sector itself. So as you say, Macy's absolutely blowing out this set of numbers, doing really well. But you look at Best Buy, not so good. You look at Dollar Tree, not so good. Hormel Foods, not so good. There's some great pieces on the MLive about what is happening here. American Eagle doing quite well. So there's a real mixed story here in terms of what is happening, Alex, in terms of where people are shopping and where people are not shopping. And I think that divide could get even greater.
Yep, I 100% agree with you. And even looking at Macy's, right, sort of the trade down effect may be working for some stores, but for Macy's, it's still the higher end consumer that continues to hold up. But does that continue? I mean, you look at some of the confidence numbers and that's telling you no.
And you do wonder whether higher interest rates ultimately support high-end spending. Because maybe the people that don't have debt can continue spending and they're going to benefit from it, but they are taking a hit in the stock market, as you've already pointed out. So our question of the day is this. Is the shopping cart, as we come to the end of the retail reporting season, half full or half empty? Is the glass half full? Is the glass half empty? Let's try and get an answer to this question. Our international economics and policy correspondent Mike McKee joins us, as does John Edwards, who leads Bloomberg's US consumer team. John, I'm going to start with you. As we come through to the end of the earnings season, how big is the divide between the winners and the losers? Is the shopping cart half empty or half full?
Well, it looks pretty full for the moment, but there's a lot of concern that it might be sort of emptying as we go through the year here. So what we've seen from a lot of retailers is a pretty strong fourth quarter, holiday quarter, and then some caution as they issue their forecasts for the rest of the year. You know, we saw that from Walmart, we saw that from Target, we saw that from an array of retailers around the spectrum. And so I think some of it is managing expectations. Some of it is concern that while the consumer is holding up now, they might finally start to weary as inflation, is coming down but still remains relatively elevated. But it's hard to say that we're going to see a real sharp decline necessarily in consumer spending. But people are being more cautious.
Well, Mike, and that just goes to what Guy was pointing out, consumer confidence in the UMich versus consumer confidence that we got earlier in the week and kind of the divergence there. It's like both of those are forecasting confusing things. Where is the consumer then? Half full, half empty?
Well, I go back to what Alan Greenspan once famously said, which was, we watch what they do, not what they say. A lot of reasons for people to be gloomy, a lot of headlines, a lot of bad news in the world. But each individual seems to have enough money to keep going at this point. And I think I brought one chart along here that basically shows we are still spending at levels above pre-pandemic. So people have not cut back at all, really, on spending. And it's been predicted for so long that it's hard to know when or if it will start happening. Everybody says, well, the stimulus checks are going to run out and the savings are going to get run down, and yet people continue to spend. Retailers have not been laying off workers yet because people are continuing to spend. So it's hard to say at this point that the shopping cart has lost any kind of ballast.
Mike, in terms of how much visibility we have with the consumer, there seems to be so many unanswered questions right now. Do economists really have a good handle on what is happening here? Everybody seems to be confounded that inflation is as high as it is. Everybody seems to be confounded that the labor market is holding up. Why aren't the economic models able to get a better handle on what is going on here and why we are seeing this consumer strength sort of being perpetuated?
Well, in one word, the pandemic, it scrambled everything so much. It's really hard to figure out what's going on because there's so many complicating factors here. We did have some supply chain problems that caused issues. When the pandemic kind of petered out, then companies tried to hire and couldn't get all their workers back, and there's still labor shortages. Retailers, for example, have fewer workers now than they did before the pandemic. And so it's been hard to try to figure out which of these things is causing how much of a problem, and it's hard to know exactly how they fit into the models. So everybody's kind of guessing, including the Fed. We have seen inflation come down some. The biggest thing with consumer spending, and this plays into those confidence reports, is that people react a lot to things like gasoline prices.
Yeah.
And gasoline prices have come down a lot. They're still elevated somewhat, but as long as gasoline prices have come down, then people seem to feel better about spending on other things.
So I guess the question then becomes, John, like, where do they spend? Because this is what was confusing me about Macy's. You could read it bearishly or bullishly. I appreciate the stock market's taking it bullishly, but there were also, like, sales are going to be down this quarter, almost 5%. So where does that leave us?
Yeah, I mean, what's happening with the consumers, they're getting pickier as, you know, as they sort of sort through this high inflation environment. So, you know, certainly for one thing, people, you know, with a lot of money to spend have a lot of money to spend. And so they, you know, at Macy's, their high-end brands like Bloomingdale's and Bluemercury were supporting a lot of their same-store sales, whereas at the, you know, more mid-level Macy's brand, same-store sales were down quite a bit. So, you know, and you know, then you see with Best Buy, you know, discretionary items like TVs and electronics, you know, not going to do as well in this environment as people shift their spending more towards services and necessities.
We all bought a lot of tellies during the pandemic. John, the situation at the moment seems to be fairly mixed. If you're Macy's, you're doing fairly well. If you're Dollar Tree, maybe you're not. Walmart, I think, encapsulates the story really well. The numbers are okay right now, but looking forward, we just don't have a clue. How are retailers positioning for what comes next?
Well, yeah, I think what they're trying to do is be, you know, cautious and sort of leave themselves every opportunity to take advantage of the spending that's there while not necessarily counting on it to remain. So, you know, that's, you know, you mentioned Walmart, a perfect example. You know, they're very good at managing expectations. And, you know, what they've said is that, you know, despite the fact that they had a really blowout fourth quarter, they are cautious on, you know, where the consumer goes from here, you know, and they're going to be minding their merchandise mix, you know, and Walmart is in a fortunate position that they have such a large grocery operation that they can, you know, weather some of the declines in discretionary spending better than, say, a Target can.
Right, and then you saw Kroger still felt pretty positive about passing on price increases and dealing with all that. Guys, thanks a lot. I feel like Mike was also talking about me in terms of spending. Mike, thank you.
Yeah, I just want to know if spending overseas doesn't count.
Doesn't count. No, okay, if that's the case, it doesn't count.
Mike,
then I'm sticking to my budget.
It's like chocolate.
Mike, we are all waiting. We are all waiting for Italian retail sales. That is the number that everybody should be focusing on.
It's totally true for February. 100%. We're going to be breaking that huge. All right, guys. Thanks a lot, John and Mike. We appreciate it. Okay, as we had to break here, we're looking at live pictures of U.S. Secretary of Commerce Gina Raimondo. She's in a fireside chat with Bloomberg Washington Bureau Chief Peggy Collins. Feel free to watch that in real time, live go on the terminal. She's currently talking about CEOs being optimistic but nervous and cautious, and she feels like we're mostly out of the woods in supply chain bottlenecks. All right, coming up, more on the question of the day. Is the shopping cart half full or half empty? We're going to talk to Anastasia Amoroso, iCapital Chief Investment Strategist, next. This is Bloomberg.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
We're sort of stuck in this range, and the market continues to kind of grind sideways between all these levels of resistance, support. So if you're looking for yield, if you're a yield-hungry investor, Treasury bonds particularly are the right option here.
Yeah, the whole curve above 4% now. That was Liz Young, SoFi head of investment strategy, earlier today on Bloomberg Television. So our question of the day, is the shopping cart half full or half empty? And what happens if all of the Treasury curve stays above 4%? The Fed keeps hiking. We're going to ask Anastasia Amoroso, iCapital Chief Investment Strategist. Anastasia, you can answer that question from, say, a market retail stock point of view and then an eco point of view.
I'll answer it from the economic point of view, and I do think that the cart is half full, Alex. And the reason I say that, looking at the latest retail sales numbers, for example, we have some blowout numbers in some particular categories. If you look at restaurants, if you look at leisure, and if you look at travel, if you look at autos, those are all the categories that are doing really well. What's probably not doing well is anything that's been tied to the pandemic home improvement trend, and maybe just your basic, day-to-day shopping. So, but for the other way to think about this, the consumer is able to stomach this 5% rates economy. And there's a few reasons for that. First of all, you look at the unemployment rate at 3.4%. Consumers are employed, and they're more gainfully employed potentially as they were last year. Wages are still rising at 4.6%. So you've got jobs, you've got wages, and then guess what? You've got a lot more household net worth that has been created over the last 14 years. And sure, we gave a little bit of that back, some of it back, I should say, last year. But if you look at U.S. household net worth, it is still a multiple, a factor of what it was before the pandemic or back in, during the financial crisis. And then cash. There's $17 trillion of cash on household balance sheets. And guess what? That cash is not yielding zero now. It's yielding close to 5%. So you put all those things together, and I do think that consumers do have the discretionary spending power, and it might actually improve a little bit this year as inflation comes down, but wage growth still remains sticky.
There is an argument that says, Anastasia, that as rates go higher, the consumer spends more because, as you say, the cash that they have on hand is getting a better yield. Is that really the case? What yield do you think the Fed has to deliver here will break the consumer?
Yeah, I don't think it's 5%, Guy, because, if you look at 5%, if you look at the core PCE inflation, we're just looking at real rates still being right around zero. So that is not enough to sort of choke off the growth in the economy. I do think we have to start talking about 6.5% rates until you really get into this restrictive territory that might dent the consumer and might dent the corporates. And of course, we're not there yet. And I think at some point, the Fed will likely have a rethink of what is the right level of restrictive policy. I don't think that point is imminent. I don't think it's in March, but especially as we get into the back half of the year, and I think it's likely to become evident that inflation is not yet on track to 2%, and in fact, it might start to pick back up in the second half of the year. I think that's when the Fed will kind of wake up to this and say 6.5% rate is probably the next destination, but that's probably not the imminent stop right now.
Okay, so what happens to the curve and what happens to stocks in that kind of scenario?
Yeah, so Alex, I think for the time being, I think stocks are sort of appropriately priced for this 5.5% rate environment. I say this because we did have a pullback. Looks like we're tracking maybe 6% at this point, but we also priced in 5.5% terminal rate. So the two things seems to be in sync for me. And 3,900 on the S&P. Probably not any higher than 4,200. That's likely to be the range in which we're trapped if we stick to this 5.5% rates. If we go to 6.5% or higher, I do think we have to start talking about a hard landing recession scenario once again, and in that case, we would see stocks trade down below 3,900. This is an environment, though, I will say, it's really difficult to make a one-year out call. It's even difficult to make a six-month out call. This is something that we have to take month by month at this point, and that's why I'm not saying we have to prepare for this hard landing scenario just yet.
Okay, given that lack of visibility, a bit like the weather in New York today, what do you do? Anastasia, am I going to make more than 5% in the stock market this year? And if I'm not, why don't I just park my money in cash? Why don't I just put it in the 2-year?
Yeah. Well, Guy, you might. If you invest at sort of the bottom of the range of 3,900 and, let's say stocks do trade up to 4,200, I think that would give you a somewhat decent return. But I don't think these things are mutually exclusive, meaning cash or stocks or, bonds or stocks. I think it is a great environment because we have a luxury of being both defensive and opportunistic at the same time. So you could be defensive by parking some of that money in cash. And, you look at the 2-year Treasury yield now sort of approaching 5%. That's a great thing to lock in. And for U.S. investors who can benefit from, tax exemptions on muni bonds, that's another great space to look at. So you could do that. You can combine that with private credit, which I really like at this point, because if you look at what is it that can actually beat cash in terms of income stream, that's private credit that at this point is giving you 10 or 11%. So that's a very nice barbell of a safe asset with, a riskier asset that gives you, however, a very good return. And you couple with that with some selective stock exposures. And look, we're not going to we're not going to maybe get the absolute low. But if you commit to investing throughout this year, chances are you will capture some good valuations along the way. And we've had tech stocks report, this week, whether it's in cybersecurity, whether it's in enterprise software, they're still clearly showing they're still able to grow through this environment. And even in February, you actually look at the NASDAQ and the tech stocks, they outperform the broader markets. So that would be kind of the third part of this, multi-asset portfolio strategy that I would have. Again, we do have this luxury of getting paid, but at the same time being opportunistic.
As you say, though, very choppy, and maybe that diversification is going to help through that chop. Anastasia, thank you very much indeed. Always great to catch up. Anastasia Amoroso, iCapital Chief Investment Strategist. Still ahead, Tesla Investor Day, certainly failing up to live up to the hype. Shares certainly paying the price. The stock is down pretty hard. More on that next. The startup is coming. This is Bloomberg.
It's time for the Bloomberg Business Flash and look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares of Macy's are higher today. The department store operator reported better than expected fourth quarter earnings and comparable sales. Plus, the midpoint of Macy's full-year forecast beat the consensus. Best Buy is predicting that sales will fall a second straight year. The consumer electronics chain came out with a forecast that missed estimates. High inflation is forcing shoppers to think twice before buying televisions, computers, and appliances. Shares of Salesforce rose by the most in almost 3 years. The software giant gave a surprisingly upbeat forecast and will ramp up stock buybacks. Bloomberg's Emily Chang spoke to CEO Mark Benioff.
As we really focus on our performance, on our profitability, on the reprioritization back to being a core CRM company, it was really time to put the M&A committee on ice and just, mitigate what we've been doing with M&A and just focus more on our core. And as part of the transformation that I've put into the company in the last 90 days.
Salesforce shareholders have pushed the company to cut costs following a half-decade of aggressive hiring and large acquisitions. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. 23 minutes past 7 on the West Coast. It's getting lighter and lighter every morning. Time to get to the startup. Top tech stories from the Bay Area and beyond. Silicon Valley, starting its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, that did not go well for Tesla.
Right. You can see the bags under my eyes, the 4 hours that I sat through the presentations. I mean, look, expectations were super high. We shed $40 billion of market cap off Tesla this morning. But remember, we boosted the stock or the market cap by $300 billion in high anticipation of this event. And there was like no one headline, right? Basically, it was a big picture look at what Tesla thinks needs to happen to transition the Earth to sustainable energy economies globally. There were little Easter eggs dotted around that, but the thing that's really disappointed the street is no concrete details about a next generation EV, which we all thought would be a cheaper model.
Right. In addition, though, where he did have impact were suppliers. I mean, saying things like we're not going to use rare earth metals, we don't need to use as many chips. I mean, those are enormous statements that had a humongous impact on some of the rare earth guys as well as the semis.
Exactly.
What was your take on that?
Well, those are the Easter eggs I was talking about. So moving away from silicon carbide, which is kind of the next gen of chip making, Tesla thinks its in-house tech is better. Silicon carbide makers are falling in the session this morning. Look at some of the rare earth metals miners. Those are also falling because the next generation drive unit is only going to use a magnet-based technology, no rare earths. That's having an impact. We thought this would be about supply chain, right? We talked about that earlier this week. And we've reported, myself and my colleagues, that Tesla is in talks with different miners. Actually, the message from Elon Musk was a little bit different. It's not mining that's the problem, it's refining. I think we've got a quick soundbite of him talking about that.
We need to make just a very giant amount of anode, cathode, lithium hydroxide, lithium carbonate. It's really the refining capacity that is the biggest choke point. Yeah, so that's why we're building a lithium refinery in Corpus Christi.
So Corpus Christi up and running in 12 months. The visual there was really important too. He was flanked by other executives, and that was a pretty pointed display that there's a bench of talent. It's not just Elon Musk running Tesla.
But to come back to the chemistry, has the chemistry changed at the company? And that is why we're not getting the kind of the big reveals. This is not Elon Musk's show anymore. It's everybody's show, the entire bench. And we don't have that kind of creativity, that spark coming once more.
I've spoken to some investors this morning, and that's a concern for them. There's a lot of engineers and nerds there, less leaders, less creators, less strategists. Elon Musk takes that burden.
Yeah, but maybe that's a mature company eventually. Ed, great stuff. Really appreciate it. Ed Ludlow, Bloomberg Technology co-anchor. Coming up, Chevron seeing some lack of long-term commitments to buyers of LNG. Super interesting. More on my conversation with Mike Wirth. This is Bloomberg.
About that all day yesterday.
We're about an hour into the U.S. trading session. Stocks really going nowhere, but we're now above some technical levels. Abby's tracking the details. Abigail?
Well, Alex, it's interesting because look at this little range that we have here on an intraday basis. It's not clear what's going to happen here, but to your point, we'll be checking in on those technicals in just one moment. But these are the S&P 500 E-mini futures overnight, and you can see that the index, though, it had been down pretty solidly earlier, still down for a third day in a row. Right now, down just slightly, down 0.2%. So we're begging the question of whether we're going to see some kind of reversal. If we take a look at some of the other markets, we can see where the real weakness is. And of course, it has to do with those mega cap tech indexes, or stocks, I should say, down 2.4%. Tesla in a moment. We'll be looking at that individually. You can see that the VIX is basically flat. We've had a couple of days here where the S&P 500 is lower, but the VIX right around 20, not doing all that much, folks. Maybe not that concerned. We do have some pressure from the Bloomberg Dollar Index, and of course, yields are higher again as investors continue to try to re-rate their bets on the Fed. That 10-year yield now at 4.07. Now, relative to those technicals, I love a pretty chart. I don't know how pretty this chart is going to be. You can see that it's very busy, but I would say it makes a strong case for the possibility that the S&P 500 is still setting up for some kind of a bounce. What we're looking at here is a true range. You can see that over the last year. It's not a pretty range, but you can also see these areas of descending, falling wedges is what they're called, a bull wedge. It's basically the culmination of selling. We've had this happen many times. So right now, the S&P 500 basically sitting right around that 200-day moving average at the apex of such a pattern. Now, there is the possibility that it could go down to a lower level of support. If that were to happen, it absolutely has to hold the last low back in December. If it did not, there would most likely be a breakdown. But this chart, the pattern, the history, it really suggests the idea that the S&P 500 at some point, maybe sooner rather than later, maybe it'll be on payrolls next week, that it's likely to go back above 4,000 to the top of that range. As for some of the big movers, this is not a weekly or monthly board. This is a daily board. Salesforce.com up 12.8%. Great quarter. Macy's really soaring up 11.4%. Great quarter. They beat earnings by 20%. They're working down the inventories. Bloomingdale's and Bluemercury really helping out. Tesla, not so much, but off of its lows. That's one reason we have the index is off the lows because of the big contribution, down 5.6% on that disappointing investor day. And then take a look at this guy, Silvergate, down 46%. It is absolutely stunning, at a record low, Alex. The worst day ever, on the words that no investor wants to hear: going concern risk.
Yeah, crypto for sure. All right, thanks a lot, Abigail. Really appreciate that. Well, Chevron shares are up about 0.3% this week after its investor day. So it announced a huge buyback. The issue is, other than that, there's just no real true catalyst for the stock price. Now, I sat down with Chairman and CEO Mike Wirth yesterday in a wide-ranging interview, and one interesting part was LNG. This should be the moment for the industry. Europe needs gas. We have gas. It's not, though, working out like that.
These projects are complex and difficult to put together. There are a lot of projects on the drawing board right now, and Europe clearly needs alternate sources of gas. So you'll see a number of projects being done. But getting financing for the projects usually requires offtake contracts. Offtake agreements have been slow to come, particularly out of European buyers. And so I think that becomes a bit of a limiting factor on which projects will get done and in what sequence. That said, in commodity markets, supply comes on in big chunks. Demand grows in a linear fashion. So inherent to that is you end up in oversupplied markets at some point in time when a lot of capacity comes online, and then over time that capacity demand catches up with it and then goes past, and you're in an undersupplied market. So these markets become oversupplied at a point in time. You've got to make investments that are low cost and have a long-term prospect of strong returns.
If you want to arbitrage your overseas LNG portfolio, do you need a U.S. LNG portfolio to do that?
It's nice to have multiple sources of supply, and we've got a big gas business in the U.S., and it's growing. Not just
you need to grow it more, though, to really get that arb?
No, our gas business here is growing very rapidly. We've got a big position in the Haynesville. Most of it prices at domestic gas prices, Henry Hub prices in the U.S. We've entered into a couple of offtake agreements to convert that to LNG that we can then move to an international LNG market. So it's really about price exposure and getting some greater coverage in different price markers into our business.
Okay. It's hard to talk to an oil and gas company and not talk about the energy transition. And you guys, in your 5-year plan, you outlined investments in renewable biofuels, hydrogen, and carbon capture, and not in wind and solar. What does that mean? Like, what does Chevron see as returns in renewables? Like, are they just bad?
Wind and solar are great technologies. They're an important part of responding to the call for a lower carbon energy system. They're technologies that we don't bring special expertise to, and the returns on them typically have been single-digit returns. Our investors and our company looks for double-digit returns, and we look for things that can leverage our capabilities, our value chains, our customers, and our strengths. And wind and solar really don't fit into that. So we're focused on, as you said, biofuels, hydrogen, carbon capture and storage. We're looking at advanced technologies like geothermal that can leverage some of our strengths. So you've got to pick and choose where you're going to invest and apply your people's capability, and those are the ones where we think we can make a difference.
So that was part of my conversation with Chevron CEO Mike Wirth. And Guy, this is where, if we go back to the LNG part for a second, I found his statement very interesting because Europe needs it, Europe wants it. China's back in the market buying LNG, but the problem is agreeing on those offtake agreements. You're not going to pump $1 billion into an LNG facility if Europe's not going to sign a contract for 20 years, and there's a huge discrepancy there.
And this is why it increasingly looks like the energy transition is going to be quite disorderly.
Yes.
Nobody's on the same page. Everybody's pulling in different directions, and that is going to make for a very, very difficult story to navigate, I think, not only for the energy industry, but also for the wider economy. This is just the warm-up act, though, isn't it? CERAWeek next week, that's a big deal.
I got to dance about it because this is my Super Bowl. So CERAWeek. Every company that is any company is going to be there in the oil and tech and energy transition and green space. It's going to be super fun. Guy's going to have so much time to make fun of me on it. And let me just tell you a little bit what we're having. We have a lot of great guests lined up for you. We have SLB, I should say. They did change their name. CEO will be joining me, Lorenzo Simonelli, Baker Hughes CEO. That's definitely going to be an LNG export conversation. Trafigura CEO, Williams, oil pipeline company, a natural gas pipeline company here in the U.S., EQT, one of the biggest independent natural gas producers. We got a great lineup for you. It all begins Monday. I'm really excited.
So what? Yeah, she is really excited. This is better than shopping.
It is better than shopping.
Any one issue that stands out?
Oh, it depends on the company. To be perfectly honest, I know that that's a lame answer, but I am going to be asking all of them what's going to power their car or turn on their light bulb in 10 years, which I'm really interested to see the answer of that. Anyway, coming up, we're going to talk about alternative investing. We're going to look at the impact of rising rates with Tony Citrone of Neuberger Berman. That's next. This is Bloomberg.
So it seems the market may be finally waking up. The Fed's higher for longer warnings. Maybe they're finally starting to sink in. Yields on the US 2-year, 10-year, 30-year, now all above 4%. You're getting 5% effectively on a US 2-year right now. So what's the case for investing elsewhere? Why should you bother? Why are you going to put your money in other parts of the market? Alternatives, perhaps. Well, let's try and answer that question. Anthony Tutrone, Neuberger's head of alternatives, and Bloomberg Sonali Basak join us now to try and figure this out. Tony, great to have you on the show. Thank you very much indeed for joining all of us. So I can get 5% on a US 2-year. Why do I need alternatives?
Yeah, great question. So I guess I would start with, historically, factually, private equity does extremely well after a market drawdown and even investing during a recession. So those have been some of the very best vintages. And that's what we expect this time around also. And then if you shift to private credit, private credit right now, if you're worried about interest rates rising, if you're worried about inflation, then you want floating rate debt. And right now in private credit, unlevered, we're getting about a 12% yield to maturity. So I think it's fairly compelling. And I also think in a market like this, that the assets that trade, because the financing markets are constrained, and the bid-ask between buyers and sellers is quite wide. So the deals that are getting done are the higher quality businesses.
But
and
Tony,
so I think you're going to continue to see that going forward.
12% at what cost here? Is there kind of concern about the risk that some of these managers are taking on? And to the extent that you are concerned, where are the places to watch out for?
Yeah, so that's a great question, Sonali. Thank you. There is a lot of risk when you're investing in private credit, and as rates go up, obviously it squeezes the cash flows of the companies. So what's super important is the underwriting and making sure that you're investing in businesses that are resilient, that can withstand a downturn, that have pricing power in the marketplace in case inflation continues. And so that's extremely important from a risk management point of view. And I also think it's very important to be investing with the companies with the better private equity sponsors who have invested heavily in operating and expertise. And so that if we do see challenges in the environment that develop, they'll move very quickly to conserve cash, to preserve margins, and to make sure that the balance sheet is strong.
Tony,
so that is one of the things that you have to be focused on.
Tony, with interest rates rising so quickly, with so much volatility in rates really, how quickly are managers sitting there rushing to re-underwrite what they're doing?
Yeah, so I think that all the managers are focused on underwriting with the new macro and interest rate scenarios going forward. So what we've seen versus a few years ago, private equity is still, so we're in the co-investment business. We see about 11 deals a week. We do probably one or two of those, so about 60 transactions a year. And what we're seeing is they're still underwriting to the low 20s net IRRs. But if you look at their financial models and where those returns are coming from, it's actually negative from a multiple, what exits they're multipling at. So most of the private equity firms are assuming that multiples will contract at exit. Mm-hmm. There's really almost no value being created by leverage. And remember, deals being done today are 50% equity. So leverage doesn't have a huge effect on returns. And so what they're very focused on is creating value, accelerating revenues and accelerating earnings. And that's through M&A roll-up strategies, for example, is extremely active right now. And in fact, I think last year, about 77% of the number of transactions that were done were add-on acquisitions. It's an all-time high. And so private equity firms are playing offense within their portfolio companies. Yeah. And going forward, that's a huge way to create value because these smaller companies trade at better values. They're more open to doing deals in an environment like this, and there's synergy. Yes.
Tony, hey, it's Alex in New York next to Sonali. Blackstone has defaulted on a 531 million euro bond that was backed by offices and stores owned by a company that it acquired back in 2018. And I'm wondering, is this kind of thing the stuff we're going to start to see? I appreciate that the deals they're making now are a bit different, but is this a canary in the coal mine kind of thing?
So I think some of the more aggressive deals on the private equity side that were done in 2021, for example, I think you could see some stress in the system. And again, I think it's for weaker businesses where too much leverage was applied. So I think you will start to see some problems occurring in some of those portfolios, and either they're going to have to put in more equity or there may be even more serious issues. You specifically mentioned real estate, and obviously office buildings are under tremendous pressure right now. So within the real estate market, I do think you're going to see bigger challenges than you're going to see on the corporate side, especially in areas like office buildings, which I think the recovery there, if it happens, is not going to be so robust.
Tony, as you say, though, therefore you have to pick and choose your spots and be very careful, particularly in the private credit markets, with who you are ultimately going to lend to. We were talking to Oaktree Capital a little bit earlier on one of the previous programs, talking about the fact that they think some of the lenders in the space are going to be pulling back given the risks that are out there right now, and that is going to create an area of opportunity. You talked at the beginning of the conversation about 12% yields. How much higher do you think that number could go?
I think that the spreads are pretty wide right now, so unless there's more challenging events that occur in the economy, I don't expect that to change. But if rates continue to go up, the beauty of private debt is that it's floating rate. So you'll see yields go up along with the increase in interest rates. And to Oaktree's a point, the banks have pulled back significantly. They are on higher quality seasoned issuers coming back. So there is some increased activity by the banks versus the end of last year. The high yield markets are starting to get some flows. So again, with seasoned issuers, but in general, they pulled way back. And so even though M&A transactions are way down, the activity in private credit, at least in our business, and I think probably across industry, is way up because their market share has more than made up for the decrease in M&A activity.
Tony,
so I actually think it is a big opportunity for private credit in that way.
People are talking so much about private credit, certainly the buzzword in town these days. But what about private equity? When you're seeing markdowns starting to happen, is there another shoe to drop? Are there more kind of issues here with valuation that people are getting concerned about?
So people are very focused on valuations, and we start collecting data right away after the end of a quarter. And so we're already reaching out to general partners and asking them where their portfolios are going to come out. We only have about 25% of the data in right now, but it looks like on the buyout side, the fourth quarter is going to be flattish to slightly up in local currency. Some of the European funds or some of the European investments, if they're denominated in dollars, you'll see a bigger increase just because of what's happened in exchange rates. Now, on the venture side, we don't have very much data, but the data we're seeing is making us believe that you'll see markdowns probably high single digits potentially. And of course, there'll be a wide variety and a lot of disbursement within the VC funds and the growth. So you'll see more significant there. We also did a study of the last three downturns. And what we saw is that if you look at private equity versus the public markets, private equity peak to trough, it is delayed about 3 to 5 quarters. But the absolute decline from peak to trough is only about half of what the public markets do. So in 2008, I think the public markets went down over 50%. Private equity peak to trough was about 26%, but private equity also recovered more quickly, and by the time the public markets recovered, private equity was at a premium. And we think that part of that is due to the fact that the private equity companies adjust much quicker to the environment. We saw it in spades during the COVID downturn. Private equity businesses cut costs, conserved cash, made equity infusions where necessary, much quicker than their public peers. And I think that that's why the downturn is more muted.
Hey, Tony, we really appreciate it. Really cool perspective. Tony Tutrone of Neuberger Berman. Appreciate it. And Bloomberg Schneider Bassett, thank you for bringing us the interview as well. This is Bloomberg. Macy's shares still up a whopping 10%, posting some strong results. The outlook in certain areas looked good. Other areas was a little bit dicier. Bloomberg Technology co-anchor Caroline Hyde joins us now. She's going to interview with the CEO within the next hour. Caroline, what were the